Well, congratulations and welcome back to the FEG tax planning package. You have almost graduated. That is, of course, until I come up with bonus material and decide to do some more. But for now, you've been through the series that we suggested that you go through. If you've missed any of these, I think this is the 7th or 8th part. If you've missed any of them, make sure you go to fegtaxpack.com or call 833-TAXPACK and get signed up. We'll give you the previous videos. This is all designed as a tax building block so that you can get your tax planning put in place. I'll remind you for the umpteenth time, in my opinion, there are 2 tax codes in the United States. People try to say that it's one for the rich and one for the poor, but in my experience, that's just not the case. It is one for the informed and one for the uninformed. And as my grandpa used to say, Joe, it doesn't do any good to know what's right from wrong if you don't take action. Right? That's the same thing that I would tell you about tax planning. If you learn these things, if you learn these concepts and then do nothing with them or go, oh man, I forgot, that, ladies and gentlemen, in 35 years of doing what I do, of professionally helping more than 2,000 families work on their retirement journey, there is without a doubt nothing that has surprised people, and I mean surprised to the downside, surprised people more about their retirement than the impact the IRS would have on their financial journey. They just didn't get it. They didn't understand it. You know, people face plant and go, how did this happen? You know, I thought I was doing everything right. This is what someday I'm going to meet they, by the way. But, you know, this is what they told me to do. And they thought they were doing everything right because their neighbor at General Motors or Caterpillar or Lilly did it. And it all just makes sense. But guys, you know, sometimes we have to take a step back and go, does this really make sense? What has changed that has really changed the direction or the percentage? So at the Financial Enhancement Group, we have a program called the Better Giver. And we are very charitably driven people. Most of us spend our time in church and believe in giving. That can be what you do or not do. But if you're watching this part, it really is over becoming the most efficient and effective giver of assets that you can. It's not to increase the amount that you give. That's not our job, but it is to make it the most effective and most efficient. So there are 3 ways that you can charitably give. We call this the Better Giver program, by the way. There's 3 ways that you can give. The first one is to give cash. And far, far and away, that's what most people do. They simply write a check. I met with a guy earlier this week. He said, you know, I figured out this car company during the pandemic. There's no way it could possibly stay that low. It could have. He was wrong. But anyhow, he bought it for less than $2 a share. It's worth $26 a share now. So he tells me this in one breath, right? So remember that fiduciary focus, the 4 things you've got to bring into place: risk and volatility, fees and expenses, tax planning today and tomorrow, and real return, right? So he's talking about the risk and volatility. Remember, your mind will always move toward its most dominant thought, right? And the psychology people will tell you, not only will it move there, you will give whatever you're thinking about at the time an overweight of what it really ought to deserve in the entire decision-making process, right? So his focus was on, I bought it at 2, it's worth 26. Didn't I do a great job? And the answer is, hey, you took risk you probably didn't understand, but the result is good. 5 minutes later, he tells me he'd given more than $60,000 in cash to his church. Now, I looked at him and I said, you mean what you told me is that you gifted $60,000 worth of that appreciated stock to the church? And he goes, well, of course not. I gave this, I like my stock. I think it's going to go higher. Well, this is a beautiful thing. And I proceeded to explain to him, why didn't you gift the stock? Because, and he cut me off. Again, it's these little nuances. It's this confusion of the tax code that gets people into trouble. He cuts me off and he goes, Joe. I can't gift them the stock and still have the stock. You know, you have to, there's 30 days, there's all this other stuff. And I'm going, nope, sorry, wrong, buzz, beep, right? It's the nuances. If you take a stock and you sell it for a loss, you do need to wait 30 days before you repurchase it if you're going to recognize the loss. That is true. However, if you gift a stock that has appreciated, gone up in value, or you buy it at the same time you're gifting it after it's gone up in value, the IRS doesn't care. There's nothing in the rule book that says that's bad. In fact, if the IRS auditor was here, he'd probably encourage you and say, you are a genius, right? Because people miss this all the time. So think about this. In this guy's case, think about the marginal rate that we talked about, right? His marginal rate, we're just going to call it 30%. It was a little bit higher than that, but we're going to call it 30%. That means every dollar that he gets to deduct saves him 30 cents. So for him to gift away $1 really only cost him 70 cents, right? As long as he's taking the itemized deductions, and he does, and he's able to get the charitable gifting, if he's in the 30% marginal rate, that's his top dollar, and that's not the right number, but it's easier math, then every dollar that he takes out of his billfold really only cost him 70 cents because the IRS is going to give him 30 cents credit. That's the best way to think about an itemized deduction. Right? They don't care what the source is. They care that you made the gift to the not-for-profit entity, the church, the university, something called a 501c3. That's the clear tax code. So he's got this 30% marginal bracket, and he's made the gift. In this case, it was $60,000 that he made in terms of the gift. Over here, he's got the stock, and in this case, it is highly appreciated. He paid less than $2 a share for it. That $2 is money that he took out of his billfold, put it into his brokerage account. We're not talking about an IRA or a Roth IRA. He bought stock, right? That is called his basis or cost basis. That's what he paid for the stock. Right? It has appreciated or grown, I wish I could do my arrow different, but it has appreciated or grown to above $20 a share. It was about $26 a share based on what he told me the other day. Above $20 a share, right? That's great growth. It's gone from 2, it's gone from 18. Question number 1, has it been longer than 1 year? 12 months and a day, because there's different rules for short-term, long-term capital gains than there is for short-term capital gains. Long terms, 12 months and a day. He'd owned it for a couple of years, right? And it had grown from 2 to 20. Now, he had not paid a dime worth of taxes on that money yet, right, on that stock, because he still owns it. He still owns it, right? But when he sells this stock, and at some point in time, he will, right now, he has an $18, the difference between the share price and what he paid for it, an $18 long-term capital gain, right? Because of his bracket, his maximum exposure is 20%, right? So in order for him to sell that, he winds up owing, $3,600 or so? Something like that, right? That's got to go to the IRS because he sold the stock. I don't know if $3,600 matters to you or not. If it doesn't matter to you, FEG is probably not the right place to go because I will still pick up nickels. All right? The people laugh at me at the golf course all the time. Of course I'm picking up a nickel. All right? I will help people spend all that they can spend. But in the meantime, we're going to make the most use of every dollar we have. Ignoring tax planning is like walking by $100 bills on a regular basis. Right? He looked at me when I started to explain this because he didn't pay attention to the whole thing and said, well, Joe, it's not that big of a deal. No, it's about a $5,000 deal. I mean, literally, it's about a $5,000 deal. And to me, that's a lot of money in terms of what's going on. So in this case, he liked the stock. He had another $60,000, right? He was going to gift the $60,000 to the church. What he should have done was taken $60,000 and bought more of the stock at $20 a share, and taken this stock, it's called specific share identification, taken the stock that he bought at $2 a share, and gifting those stocks to the church. Now, his first thing he said is, Joe, the church doesn't want the stock. No, you're right, Mike. They don't want the stock. But they've got an account. I know they've got an account because FEG sets up these accounts for churches all the time, and we're happy to do it for yours. Right? So the church gets the stock. The church sells the stock. The church, by the way, is a not-for-profit entity. They pay no taxes. Church sells the stock. FEG, my company, does it on our dime. We sell the stock. The church gets the $60,000. Nothing changed from him writing the check to the church selling the stock. Nothing changed in time, convenience, nothing. This is all, in the world that we live in today, a piece of cake, as they say. They had $60,000 before. The church still has $60,000. He's taken 60 grand he had in cash, bought more of the stock, right? All he's done is taken his cost basis from $2 a share to $20 a share. Now, the stock is either going to go up in value or down in value from here, right? If he sells it, he now has a loss based on the $20 going down his new basis, or he's got a gain because it went up in value, and he's going to pay less taxes because his basis went from 2 to 20. The charity didn't get any change. Men, again, the job of the better giver is not to make you a bigger giver. It's to make you more efficient, more effective. You put yourself in a better tax situation so you have the opportunity to spend more or give more later on, right? We've done everything we can to protect your portfolio in the future, where we have the ability to make changes that are necessary without worrying about the tax implications. I mean, let's just ask ourselves an honest question, because I have lived through more volatility in the industry than people did in the Great Depression. I mean, it's crazy. I started 2 weeks before the crash in '87. I made it through the '90s. I got through the tech wreck in 2000, the worst year in history, 2002, right after 9/11. And '08 and '09 and the Great Recession, the pandemic, and now whatever you want to call 2022. I've lived through more market volatility than most people. There are times where portfolios need to be adjusted. And when I have called people in the past and said, we need to reduce this position, and they go, well, how bad is the tax exposure? Well, it's bad. I mean, we have stocks that we literally have negative basis in, meaning that the distribution, the amount of dividends and interest dividends that we've collected is greater than the original share price after the splits. Right? Now, you never really have negative basis, so don't get confused on that. But the bottom line is the basis is very low. And the stock price, let's say, is $200 a share. And we need to reduce it because of market volatility. But every dollar you sell, you're exposed to the IRS. And so people have held on longer than they should. I can take you back in history with General Motors stock and watch this Lilly stock in the past, Caterpillar stock in the past. I can walk you through multiple situations where people wanted to reduce positions and didn't because of the tax impact. Not only here is the charity getting the same amount of money, but you're eliminating some of those tough tax decisions that you have to make later on. So there's always three things that people can gift: cash, appreciated assets, or depreciated assets. As a rule, never give away a depreciated asset. Just don't. Doesn't make sense. It's better for you to sell it, get the cash, and then gift the cash. If the asset's appreciated, especially if it's longer than a year old, you gift the appreciated stock. Even if you don't itemize, even if you didn't get to deduct the amount of money that you gave the church, you are still better off to gift appreciated stock. Remember, that's not money in an IRA or 401k or a Roth. This is money that's exposed to the tax. You're still better to gift the appreciated stock than you are cash. The only time I would say anything different, and that's not a no-brainer, is if you're 70 and a half and older and you've got money in IRAs, you can use what's called a qualified charitable distribution. That gets to be too complicated to put in a short video. So again, pay attention to the nuances. Work with a professionally trained advisor. Just work, take the general stuff that I've given, get a better understanding of what's going on. But I would strongly encourage you to work with somebody who does this professionally, not sell stocks. If they try to sell an annuity, it's probably not the right place for you to be. Work with a fiduciary. If you're doing it on your own, God bless. I hope this was helpful. If you want to help the FEG, the Financial Enhancement Group, that is our business. We are fiduciaries. We take care of more than $600 million for families in more than 30 states. This is our 25th year of being in business, my 35th year in being in the financial services career. We have 6 partners, and we are just very, very, very fortunate to serve more than 1,100 families across the country. If you want to have that conversation, just go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We'd be more than willing to invest 90 minutes of our time, complimentary, to sit down to share with you things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Again, you can find us at yourlifeafterwork.com or go to 800-928-4001. Just ask for Brittany and get set up for a time. I hope you enjoyed the tax planning message for 2022. If there's anything at all we can do, do not hesitate to let us know. Have a great day. Take care.